Hi, everybody, and welcome back to yet another cracking installment of The Matt Brown Show. This is the Private Placement Perspective series, where I am connecting you to venture capitalists and people in the world of investing. With us on the line from Comeback VC is Tony Olivito. Tony, welcome to the show.
Yeah, thanks for having me.
The privilege is all mine, man. I spoke to your partner, Scott Shane, recently as well, so it's good to have you here too, because I'm keen to get your perspective on the world of private placements. But for our viewers around the world, Tony, who haven't heard about you and what you're getting or what you're up to at the moment, why don't you give us the elevator pitch about yourself and give us the kind of backstory to how you got your start in the world of venture capital?
Yeah, so spent most of my career in a large corporate setting. And then about 8 years ago, I took an entrepreneurial path. I started up a microfluidic manufacturing company. And around the same time, I started investing in startups. Invested in, one, two, and then three. And then decided, okay, if I'm going to do this, I need to need to be serious about it. Need to build a portfolio. And around that time, I met my now current partner, Scott Shane, and he was angel investing as well. And so we were sharing deals with each other. And then not too long after that, we had a kind of a serendipitous moment where we met a couple of Silicon Valley entrepreneurs and VCs who were doing a bus tour through the Midwest. And we connected with them and pitched them on our idea of starting a fund focused on investing outside the coast. And that's how Comeback Capital came about. And so that's our, that was our thesis 5 years ago, right? Which is, capital's concentrated in 3 states, but there's a lot of opportunity elsewhere, right? And so that's how it all got started. And so we invest in pre-seed, seed stage companies, really in any industry, software or software-enabled services.
Okay, great. So how big is your fund currently?
So the fund is approximately $12 million. It's a rolling fund. So
okay, I see.
And so it's our third fund.
All right, that's great. And what was interesting when I was chatting to Scott, he was saying that, over the last 20 years or so, he's done about 100 investments. And I think he was saying like 4 of them have given him 95% of his returns. And I was like, well, that hasn't changed much. And I'm reading this book called, what is it called? VC, An American History. And it starts off basically talking about the whaling industry, which is really fascinating because it was the first, like this is in the 1800s, was the first real example of venture capital. So you had in the structures that we're familiar with, where you have a fund, which was a voyage, then you had, captains, which were founders, and then you had, all these different ships which would go out to essentially harpoon whales and things, and with the, they would come back either incredibly rich or lucrative as captains, and their reputations would be restored, and then we'd get backed again. It's sort of things you might find venture capitals having preferences for. And then, and if you failed, it was kind of like it was a bad thing, like you were shunned and kind of like put to the side. So it's really interesting to know that VC as a structure, venture capital as a structure, hasn't really changed too much in the last 200 years.
or longer, right? Like,
yeah.
I mean, you go back to the founding of this country and exploration of North America and South America. It was the same thing, right? The LPs, right? The investors were the kings and the kings of those various countries in Europe, right? Who were funding folks to explore the new world, right? So it goes back even further. But I think, yeah. I mean, there's certain fundamental things, right? It's risk. Right. And risk hasn't changed, right, throughout history. Right. And it's if you're investing, it's how you manage risk. Right. And so it's about making small investments, relatively small, right, creating a portfolio and diversifying your risk. Right. So diversification, I think, has been a principle that's been around implicitly for centuries. Right. So so that hasn't changed. And that's what we do, and that's what modern venture capital does, right? Uh, you make a lot of bets, and there's a lot been written about how it skews to the winner, right? That the returns are based on, the 10%, 10% of your high performers, right? Generate your return the fund, right? So, no, the financials haven't changed much. I would say that the last several years, though, has skewed our understanding of expected returns, right? Because if you go back, and if you look from like the late 90s until like I'd say about 2007, 2008, before we started having like the explosion of mobile apps, like the VC return for the top decile was only about 10%. Was only about 2x, right? And then we had this explosion caused by mobile phones and mobile apps. And so for about a decade, that top decile return, went up to 3x, right? And so the question now in this environment is, what's going to happen going forward? Are we going to have a reversion to the mean, right, going forward for the next decade or so, right? So it's yet to be written.
Yeah, I want to just double click on this idea of risk that you touched on earlier, because it seems to me like by the way, this book again is quite fascinating because you start to see how this idea of early stage returns wasn't actually proven for quite some time. It was really the whaling industry, and then but for a long time after that, there were question marks around whether or not it could work, and very few funds could actually get it to work. And so when it comes to early stage, businesses die. Like that's the truth. So how do you balance risk? Like when you look at a portfolio of say 100 companies or 35 companies, if you have a fund that's, a 10-year fund as an example, and you want to put, I don't know, let's say 80% of that into, or cut checks of 80% of that into a portfolio quite early on, there's a lot of risk, right? That you have to consider. So how do you mitigate that risk? And then if you could just paint a picture for us around like how do macroeconomics play into this? Do you care? Is this kind of like, well, look, there's a founder with a great business idea, or they have revenue. I know that was one of the things you guys look for is revenue. So, the business model has kind of been proven. It might not be perfectly scalable just yet, but that's okay. You got customers, So risk, walk us through how you mitigate that as a venture capitalist.
Yeah. So I think I'll go in reverse here, though, right? Because you talked about how does macroeconomics influence it, right? So macroeconomics influences how we view risk, right? And so I think the short answer is requiring greater traction because of that risk, right? And there's a lot of risk. We can talk about what all those risks are. It's not only whether the company will hit its next milestone, but there's also the risk of, even if they do hit their next milestone, will there be other investors out there who will help continue funding the company to grow, right? So those risks kind of change, I think, how a founder approaches their capital raise and their capital plan, right? Like, I guess you can't count on, hey, if I'm able to raise, I'll be able to raise again in 18 months at a higher valuation, right? So I think it has to influence the founder, and so we're looking for those types of founders, right? Who have adjusted to the macroeconomic situation, right? And who really put pen to paper and have come up with a good plan to be like capital efficient, right? And have that capital efficiency mindset, right? And knowing that capital is going to be difficult for the next, who knows, right? Like 18, 24 months, right? So that's one way to approach risk, right? And minimizing risk is like, are you planning to use your raise, right, in an efficient way to make it last longer, right? As well as you mentioned, right, traction, right? So that's important for us. And when we talk traction, we're looking at companies that only have a couple $1,000s of revenue, right? So it's not like there's huge amounts of data that you can look at, right? There's not. But even those signals mean something. Like, so I mean, there's a huge difference between a pre-revenue company and a post-revenue company. That's amazingly hard to kind of go from pre to post-revenue, right? And so if they can cross that chasm, right, that's a signal to us, right? And then we look beyond that, like, okay, well, how quickly have they done that? Like, how quickly have they gained customers in the last 6 months, right? So for us, we manage the risk by really trying to better understand how close they are to generating revenue. You know, they're generating early revenue, but we really try to understand better, like how quickly they can grow, right? So we try to get under the hood and understand that better.
So on this, you mentioned the stage of business earlier, and now obviously we're touching on revenue generating. Do they have to be technology platform-based businesses, or do you touch services businesses? And when wouldn't you touch services as an example? Because obviously if I was sitting in your shoes, which I'm not, but if I were, I would be looking for platforms, things that could scale repeatable revenues, not project fees, things like that. So walk us through when do services matter, or is there preference in terms of like type of early stage business?
Yeah, no, I mean, we don't have preference. So, I mean, we invest in like SaaS businesses, but we also invest in tech-enabled services. The requirements, the milestones are higher for tech-enabled services, right? Because it's a slightly different business model, right? It doesn't have the same type of margins as a SaaS company would, right? Doesn't mean we shun away from them. And actually, like some of our best investments, right, are tech-enabled services, and I think that could be because other VCs shy away from them, right? They're not sexy. It's out of theme for a lot of VCs, right? And so, absolutely. I mean, founders can create businesses in tech-enabled services. Investors can make money in tech-enabled services, right? It's just finding the right opportunities, the right match.
When it comes to raising your fund and talking to an LP, could you describe from your experience when you are engaging with an LP, like how are they evaluating risk when it comes to a fund such as yours?
Yeah, so we haven't raised, right, in 2 years or so, right? So it's definitely changed in that time. I could talk about our experience 2 years ago, and then also talk about like what's happening now, right? 2 years ago, LPs were, as a VC, you want to find a match between your thesis, right, and your strategy and the LP's interest in investing, right? So what we found was that there were a lot of their investors on the coast who were interested in trying to find opportunities in the Midwest and just outside of the coast. There are family offices who were looking in the Midwest who are looking for opportunities, and there's individual investors, right, who are looking for opportunities, right? And so, they aligned with our core strategy, right, of geography, of the types of companies we're looking for, right? We weren't unicorn hunting, right? That's what we do. Of course, we'd love to have a unicorn, right? But we believe that we believed, and we proved it in our first fund, right, that you can have great returns and not necessarily have, unicorns, right, by maintaining discipline in your investment decisions. In today's environment, though, right, LPs, and like last week, I don't know if you caught this, but like A16Z announced that they're reducing the size of their flagship fund, right? And that's like one of the most venerable venture capital funds in Silicon Valley, right? And they've reduced the size of their fund, right? That's an indication that they're getting messages from their LPs, right? That, you have to, in this environment, right? You need to adjust, right? Because for the last 2 years, investors were just, you know, spending money like crazy, right? There's lack of due diligence, valuations were crazy, right? So LPs have definitely changed and communicated to the VCs, right, that they're being more conservative, right, and investing in this asset class.
Yeah, I just pulled up the that article, and Jason Horowitz deals by quarter. Yeah, I mean, it's fallen off a cliff, quite frankly.
Yeah.
They can try and spin it however they want, but that's data doesn't lie, my friend. And go ahead.
Oh yeah, no, exactly, right. And again, it's because of, like, they're in a different realm, right? They're dealing with institutional LPs, right? Where I described our LPs, they're different, right? But so you can see in that realm, right? That's what institutional LPs are thinking, right? They're reducing their allocation to the asset class, right?
How do you combat that as a fund? You don't really have much choice. You know what I'm saying? If you have, let's just say 100 LPs in a $2 billion fund, let's say, and part of that, let's just say distribution wise, some of that's institutional, and they just go, well, it's actually time just to hold on to our cash and wait it out. Like, how is there a way for you? Because remember, one of the key things that I've learned through doing this series and talking to other VCs is that LPs, sometimes their thing is it's liquidity, because once you put capital into a fund, you don't get to draw it out. It's not a piggy bank. You're in, and that's it. So there are, clawbacks in this whole engagement, aren't there? So to protect this eventuality where LPs are saying, listen, we actually, we want to be more selective around which funds we want to invest, or maybe we want to invest less in Andreessen Horowitz as an example.
Yeah, I mean, so how do you combat that? So, I guess if you're raising a fund currently, right, there's a couple ways that funds are doing that. They're extending the investment period, right? Because in the past couple of years, they were investing in 2 years, right, which is really short historically, right? Go back 5 years, like the investment period was at least 3 years, right, where you're making investments. So you could raise the same size of fund, but invest that over an extra year, right? But I think it's difficult to combat, right? Because there's lower activity, right? And people don't want you investing in bad deals, right? So you have to prove to them, right, that there's still good deals available, and you can maintain your pace of investment. And fortunately for us, we were targeting, one investment per month. We're not too far off of that pace without compromising our criteria, right? So we're a little bit behind that, but not significantly.
Yeah, I mean, just to maybe end on this point, but if you go back literally year on year, it's a 66%, roughly 66% drop in investing or investments made. That's a lot of money, man. Imagine that, because that affects your carry, your potential upsides, basically everything. So it's not to be balked at.
Yeah. So I mean, one thing in this discussion, right? You kind of have to segment, right? There's different types of funds, right? We're at the pre-seed, seed stage, and most VCs, and there've been tremendous amount of new venture funds that have been created, right, for the first time in the last year or two, right? I think several thousand of first-time VCs. And the path is generally you create a fund, you get some traction, you raise another fund at a higher fund size, because that generates fees. And most venture funds, those fees are pretty significant. They support the infrastructure, but also it supports the VCs, right? And so that's why fund sizes keep on getting bigger, right? Our fund's a little bit different where we're aligned with our LPs. We reinvest our investment fee, and so we're not living off of the fees, right? We're putting it back into the fund and making investments, and we really don't plan on going upstream, right, and trying to increase the size of our fund, right, because it kind of changes our model a bit, right, because we're focused on cutting $250,000 checks in pre-seed rounds of less than 750,000, right? So these are small rounds, so we can't cut large checks, right? Because we want to leave room for our LPs to sidecar with us. We want to leave some room for some other funds to participate with us, right? So, so if our check's 250,000, right, it's not like we can, create a huge fund, right? Because we only do one a month at 250,000, right? So we can't grow into like a $30 million fund because that changes the types of companies that we're going after.
Mm-hmm. So how do you find LPs? I mean, are they lying on a park bench somewhere, or?
No, it's it's through our individual networks, and ours, I guess our LP network is pretty diverse in the sense that, as I mentioned at the beginning, it's GPs and partners from other VC funds, right, who want kind of early access to companies, right, and so by investing in our fund, they get to see companies, right, and they get kind of a first view on companies that are doing well in our portfolio, so that they can take a look at them potentially for their funds, because they're later stage investors. And again, so that's through just our existing network. And then, we do a couple of conferences, a year. And so we continue to meet other investors. So, that kind of helps us broaden our network. But really, we don't do, like, a lot of funds spend the entire year. It's a sales process, right? It's getting a list, doing reach outs, right? And I guess, again, given the size of our fund, we hadn't had to do that, right? But a typical fund will really just spend a whole year or more just pounding the pavement, sending out emails, reaching out to people, and trying to set up meetings. Yeah, mm-hmm. It's a sales process, really.
Yeah. All right. Cool. So we're going to come back to you in a moment, Tony. The Matt Brown Show is presented by Carafin, an investment bank that offers and supports direct private investments in U.S. operating companies. Over the past 20 years, investors have placed over $1.2 billion of private debt and equity in more than 100 companies through Carafin and its affiliates. Carafin leverages technology to empower its community of investors to deploy their capital far more efficiently than ever before, and connects their community of engaged investors with worthy companies. Invest portions of your portfolio in direct private investments today. Visit carafin.com/Matt Brown Show for more. And we're back. So, Tony, you get pitched a lot by early stage companies. Where does it go wrong for them? What would you hang your hat on? Is there a commonality that you see more often than not? Let's just say there's 10 things that you typically find them getting wrong. Is there one thing that stands out head and shoulders above them all?
Yeah, I mean, I think a poor pitch, and we can talk about what makes a poor pitch, right?
Yeah.
I think probably the greatest thing is just not being able to answer questions succinctly, right? So if you're asking the question about, like, a typical pitch has a normal flow, right? It's like problem, solution, market, business model, right? Funding. And for problem and solution, like those answers should be pretty succinct, pretty focused, right? And they happen at the very beginning of the pitch, right? And so if you can't do that right off the bat, you kind of lose the investor's interest, right? If you're not able to like quickly succinctly get to the problem and define your solution.
Mm-hmm. Yeah, and also projections I find is another one. Most of them don't hit them, or they think that they're going to be a unicorn, and when they're more like a donkey.
Yeah, I guess having unrealistic expectations. I mean, obviously, investors want to invest because they think there's a big opportunity, right? I don't place much emphasis on projections, particularly projections that are like further than like 24 months out, right? Because who knows, right? Like I'm just trying to understand like the next 12 months, right? So that's for me, that's key, is just trying to focus on the 12 months and how realistic that is.
Yeah, exactly. And how based in reality is that? I think that's a big one. So you've obviously been successful. You've obviously made mistakes, like anyone has really. But what has been your greatest success and failure, and what would you say, Tony, made the difference?
Greatest success. So greatest success in terms of investments, yeah. So you invest in all these things, right? Because you think that they have an equal chance of succeeding, right? But the ones that you think are like really strong end up like not succeeding, and the ones that you thought were like good turn out to be like stars. So what's the one commonality? I think where we kind of compromised on, I guess, some of our key criteria, and I think our key criteria is, and we talked about this at the very beginning, right? It's about growth, right? Because VC is about growth. Like we're given money, right, to add fuel to the fire, right? And if there's a company that's been around for a lot of years, right, and they're approaching us, and they haven't had much of if they've been pretty linear in terms of growth, right? Like we've made a couple mistakes there, right? Because we've invested thinking that, they're going to be able to like hit that inflection point, and they haven't, right? It's stayed linear. And so that's been a pretty common, I guess, mistake that we've made in a couple in areas where we've made mistakes in terms of investments. In terms of greatest success, what's made the difference? I think it's finding opportunity where others don't, right? Where others have been overlooked, where founders have been overlooked, right? Because I guess we don't judge by hot investment themes, right? We're not chasing hot investment themes. We don't judge exclusively on models, right? We don't rule out things because of, I guess, factors that other VCs would, right? And so that allows us to take chances on, like what we were talking about, like service-enabled technology companies, right? Or tech-enabled service companies, right? Some of our best investments have been in that area. And so I think the key there is it matched they were growing quickly. We weren't biased by the fact that it wasn't sexy, right? That it wasn't SaaS.
Okay. So just something Scott mentioned to me, and I'm curious to get your perspective, but when you're backing an early stage founder, many of these guys haven't built a company before. They're kind of like, this is our first startup. And there's this old, analogy of, do you back the horse or do you back the jockey? and or the founder or the business or a bit of both maybe. Where do you land on that issue?
Yeah, I mean, the horse is not going to make it to the finish line without a jockey, right? Like, so I would say bet the jockey, right? You need a founder, especially at that early stage, right? That the founder, it doesn't matter that he's a first time founder. Like, we don't care about that, right? If the person demonstrates the skills. And early on when we're investing, there's only like 3 people like on the team, or maybe a couple more. And so that founder has to be skilled in a lot of different areas, right? We prefer that there's at least somebody on the founding team who can sell, right? That's important, right? So yeah, I say bet on the jockey, bet on the team.
Yeah, absolutely. So when you do make an investment, when you do cut a check, is there a particular structure that you use in terms of the deal? So do you use a safe notes because they are pre-revenue? Do you price it around if they're generating, I don't know, for argument's sake, $1 million a year? When do things change, and where do you fall on preferred capital structures?
Yeah, so I mean, you've been talking to a lot of VCs. You're exactly right. Like, you just nailed it, right? So I mean, we use standard documents, right? So that's one of the great things with working with us, right? Is that we're fast, right? And we're fast because we try to standardize, right? And you don't want to be spending a lot of money on legal. So at the earliest stage, right, we do use safes, and you just download the YC standard safe off the internet, right? And we don't make changes to that, right? We're not going to like go through and lawyer up and make changes, because the whole purpose is to make it simple, right? So, and the same thing for a price round, right? When the company, so I think it depends on, so doing a price round depends on the prior financings, right? And how much the round size is. But if you're doing a priced round, same thing. Like, we want to use like a standard NDCA standard C documents, right? Just to make it easier.
How do you price it though?
How do we price? How do we price it in terms of valuation?
Yeah, because I had this one startup who came to me and they were like, "Look, we really want your services, but we can't afford you." So I'm like, "Cool, well, let's do a warrant." So I'll issue a 10-year warrant, and we price the share based on post money because you need a raise. So I think we landed on like $1.60, but then I was like, "Hang on, but how did you get to $4.5 million?" You know what I mean? Like, who priced that? Was it done by an auditing firm, or did you just say you worth that? Because like, if you're just looking at a competitor who's doing a similar thing and saying, well, they're worth X, doesn't it actually? It's not really a good way to value, what you're actually worth. And so you get in this situation where it's like, well, how do you like determine the valuation of a share in the context of a warrant? You know what I mean? And then, by the way, if you're then doing priced rounds, it's like, well, you still got to value this thing. So have you got a model for that? Do you is there a specific process that you guys work with?
Yeah. So, I mean, okay. So if we're talking priced rounds, right? So the company's generating some revenue. And so what we're seeing in the market today, and these are deals that we're doing. And again, it depends on the company, right? And where you are, your geography, right? And the type of startup, right? Because look, if you're doing something in the LLM space, machine learning, right? Today, like, the valuations are crazy, right? If you were doing something in crypto or blockchain, valuation a couple of years ago, the valuations were crazy, right? But I'm just talking about just general, like a general SaaS company doing B2B, that deals are getting done at like 7x, right? They're reverting back to valuations from several years ago, right? So 7x revenue, right? So you could, I guess, if it's So I guess you can impute a valuation, right, based on revenue. Now, of course, that gets more difficult, right, if the company doesn't have a lot of revenue, right? That's always the challenge that we have, right, as investors and negotiating valuations with startups, right? Um, and then you have the other factor, right, that you mentioned. If it's a warrant, well, you start with the valuation, right? But a warrant's essentially an option, right? And there's discount, right? So, and from what I've seen, like the discount can be as high as like 60, 70% to a fair market value, right?
That's
So if
nuts.
the company, so yeah, so I mean, if the company is doing, let's say, for sake of just making this an easy example, $1 million of revenue, 7x multiple, so the company would most likely be valued at $7 million, right? But you're talking warrants, options, you could discount that by 70% and get the value of the company, divide by a number of fully diluted shares, and there you go.
So yeah, it's fascinating. I've sold a few companies also, and it's quite interesting when you're trying to sell too. You come out the other side, and you're looking to offload, and what valuations your broker will use versus what the actual acquirer will say you're worth. And then you're sitting in this because the broker's incentivized. The higher the sale, the more money he or she gets. You want the
Yeah,
highest price possible, so and then the acquirer is trying to buy you for as low as possible. So,
yeah.
it's kind of
Exactly.
like,
Yeah, yeah. So keep. I'm really interested in this. So keep going, right? Because this is an area that like is not discussed, right? Because it seems odd to talk about exits and how they're truly done, right? When you're founding a company, when you're investing in pre-seed, right? Like it just seems like it's so far off, like don't even bother. But this is a good conversation for founders, right? Because like what really happens when there's an exit? It's what you're describing, right? Like an advisor gets involved, right? And he'll present like information about here are the market comps, right? And you're like, oh wait, no, those multiples, okay, those weren't the multiples that I was thinking. I want that multiple that I saw in TechCrunch for my competitor, right? That just raised a Series C or Series D, right? Um, so yeah, what's your perspective on that?
yeah.
Let's keep
So,
talking about
well, it's timings. That's the biggest thing. So it's the story that gets you the price. That's what I've learned. So you can have two businesses, but one quarter makes all the difference because an acquirer will look for any data point to substantiate why you're not worth the asking price. Anything. They'll look for something. You don't have the right management team. Your revenues tapered off, in the last quarter, or your revenue year on year is less than what it was before. So blah, or you don't have any technology enabled services. It's like, or like whatever. They'll find something. And so what I found is you got to know before you start the process what you want, what you'll walk away with, and how much is enough. Because I think if you start asking yourself that question when you are in the negotiation, you fucked. Because then you don't have time, dude. Like you got to move. And acquirers don't come around every day. Like you actually need to work, and it takes a long process to get to a decision. And then what I've also found, maybe to end on this, is terms are more important than price. So oftentimes you'll find you'll walk away. Let's just say you worth the deal's worth $3 million. So the acquirer says, "Cool, I'm prepared to offer you $3 million, but you stick around for 3 years as part of an earnout." And now I'm like, no, I'm not doing that. I want a 1 year earnout, but then you can pay $2 million, but I'm not sticking around. In other words, because you don't want to put your total exit price, what you get at the end of it, on an earnout. So you have to be okay with what you initially walk away with. So whatever that transaction price is on close, not what your future earnings upside will be based on you sticking around and getting a higher return on equity. So terms are more important than price. So you always wind up like I've never been in a situation. Well, it happens most of the time. You don't get what you're asking for, and this is, by the way, the same thing with when you're trying to sell equity as part of a a raise, right? It's the same thing. It's like, well, how much are you prepared to give away equity, and for what? And what terms are associated with that? One of those is, can you be my lead investor in the next round? Because I don't want you now in like your pre-seed and then you walk away at Series A because you can't. So there's lots and lots of things to consider there.
Absolutely.
So
yeah, I think.
Yeah, go ahead.
Yeah, no. I think that's great. You hit it right on the head. You hit the nail on the head, right? It's like founders, with the analogy back to founders and raising, right? It's really when you're raising, it's a marketplace, right? It's an auction, right? And so managing that capital raise process, right, is you're trying to get as many offers at the same time, right? Generate as much interest as you can to get offers, right? So that you can compare, right? Because if you only have one offer, then you got one offer, right? And it's a little bit more dire when you're a startup because you're burning money and there's probably like there's probably a short runway, right? And so you have to make that decision. It's like, okay, well, what other choice do I have, right? If I don't take this offer, is there going to be another one that comes around, right? So that's why it's important to, start the process early, make sure you have enough time, and run a good process, right?
Mm-hmm. Absolutely. Tony, what keeps you up at night when it comes to your portfolio or the world of venture capital?
Yeah, I mean, I'd say obviously like how the economy is going to impact performance, right? And impact our company's abilities to raise additional capital, right? So we constantly are engaged with our portfolio companies, right? And helping them kind of see the risks that are out there, right? And making adjustments, right? Because in the last 12 months, you've had to make adjustments, right? So, and I think people in 2022, I think people were thinking like, oh, well, we're taking a dip in the second half of 2022, but, it'll take 12 months to work through, right? And then we'll be back to the way we were. Like, I don't think that's the case, right? And so that's what worries me, right? So I don't think it's like this V-shaped thing where like later stage financing is going to like jump back up to where it was in 2022, 2021, right? So in the hard part as an investor, right, you try to you try to communicate that to founders, right? But they're getting information from everywhere, right? So you're concerned about whether or not they're internalizing that, right? So maybe the more times they hear it, right, then they start to internalize it and then can adjust.
Mm-hmm. And Tony, when it comes to the future in the next 10 years, say, how do you see the world of venture capital changing?
Yeah. So how's it going to change? I would say that, because I've been kind of in space now for investing like 8 years, right? I've seen 10 years, close to 10 years, right? And how it's changed. And I think it goes in waves, right? I think you're still going to have some dominant VC players. But I think knowledge is pretty diffuse, right? Like, there's so many places to get information if you're a founder, to like get information about how to create a startup, how to raise capital. That I think what you're going to continue to see is, more startups outside of the traditional hubs, investment hubs of California, New York, and Boston. I think that's going to continue. And so you're going to continue to see, I think, companies pop up in places like, Chicago, Nashville, Austin, and that's going to change the VC landscape. but I don't think traditional VC is going to be taken over by crowdfunding or a different model, right? Like it's become a little bit more. VC has become more efficient. They've made bad decisions, right? But I truly don't see a different model in the next 10 years taking over VC.
Yeah, until there is. I mean, like, so one thing just a nagging thoughts I have as a visionary brain. Like, I think about AI and I think about how decisions are made from a VC perspective, and saying, well, if you truly had artificial general intelligence, and that's going to change every industry, it will change venture capital. And if you have 1,000 new funds, like you pointed out earlier, like they're all making subjective decisions. And one of the general partners told me, he said, one of my greatest fears is making all these investments and then my portfolio, waking up one morning and my portfolio reflects my biases, and I was like, that's a really interesting thing because, it is a very subjective thing around who's cool and who's not. With obviously there are exceptions like SaaS companies, you can plug in, capital vehicles or asset classes into literally their revenue numbers, like at a bank statement level. And that does exist. But for a lot of the other firms that are venturing, there's frameworks and processes and that, but, it's super subjective.
Yeah, I guess I'm looking at like the pre-seed seed stage, and I think models require information, and there's not a lot of information at that pre-seed and seed stage, right?
Exactly.
It's very subjective, right? So I think models. Frameworks can help, but I'm not sure how you can. I don't know how you can train a model if there's not information. If there's not information to feed into a model, right?
Totally.
Absolutely. I absolutely agree with you that as you get further along in later stages, right, then I see how it could have an impact, right? But again, all my comments is because what I know, which is pre-seed and seed, and there's not enough information to really create a robust, AI that can help, right?
Cool. Well, look, Tony, it's been great chatting to you, bud. I can see you get excited about the future, and that's great.
Sorry, I know my hands have been waving.
No, that's cool, dude. I love it. I love it too. But thank you for your time, and thank you for being on the show. Your perspective matters, and I'm sure it's made a difference to our audience. So thank you.
Thank you. Take care.